Khatija Haque is chief economist at Emirates NBD, live in the studio this morning. Hello, Khatija. Good to see you.
Good to be here.
Can we talk about a report that you guys put out over the past 24 hours or so with the headline, Dubai CPI was unchanged at 3.3% year on year for December. Brandy picked up on this one yesterday. 3.3% it's above most central bank targets, but it's down sharply from almost 5% in 2022. How would you summarise what's happening?
So we've seen a significant slowdown broad-based across most of the categories in the CPI. Now, the only sector where we've actually seen falling prices has been transport, and that's reflecting much lower fuel costs this year relative to last year. Remember, last year we had oil prices over $100 a barrel, or rather 2022 at one stage. That obviously came off quite sharply in 23. But when we look at things like food prices, the cost of hotels and restaurants, entertainment and other services, we've seen inflation slow. Where we haven't seen inflation slow, and I think everybody will recognize this, has been housing costs and the cost of household durables, which are things like furniture, appliances, but also includes the cost of domestic workers. So we did see inflation accelerate in those categories in 2023, and also education. So on the education side, we had inflation of 2% last year, and not very much in 2022. It was there was no increase in 22. So we have seen some areas rise, but by and large, we've seen disinflation in 2023.
3.3% isn't bad when parts of the world have had double-digit inflation over the past couple of years. What's your outlook for Dubai inflation in 2024?
So I think one of the reasons why inflation, not just in the UAE, but the rest of the GCC hasn't been as high as what we've seen in some of the developed economies is because we have a very flexible labour market. So we've not suffered with the labour shortages and the corresponding increase in wages that we've seen driving inflation in North America and Europe, for example. So I think that's one positive. In terms of the outlook for 24, we do think inflation will continue to slow. So, we don't expect a significant ramping up in energy prices, for example. We think the, growth in demand will probably moderate. Higher interest rates are weighing on investment. They are weighing on consumption. So I think that should help to bring inflation lower. But we do think that housing costs will continue to rise. Now, we've seen a big increase in the market cost of housing in Dubai, but that hasn't fully fed through to the official CPI, and that will take some time. So we do think the housing component of the index will remain elevated and potentially rise a little bit further before it starts to ease.
OK, that's the situation here in Dubai. Let's look more broadly. Let's look more globally, because, of course, that has a massive impact on us through interest rates. What the world's central banks do matters. Last night, we had the Bank of Canada. It was their turn to set rates. They kept them on hold. They've been on hold since July. Have a listen to Tiff McClem now. He's the governor of the Bank of Canada. He said, and you can hear him now, rates are on hold and they're probably not going any higher.
We've seen some progress, but that progress has been uneven. And as I said, we're concerned about the persistence in underlying inflation. And what that means is that it's premature to discuss reducing our policy rate. Our deliberations are shifting from whether we've done enough to how long we hold. But there was a clear consensus. It's premature to be discussing cutting our policy rate. We need to see more progress before we have that discussion.
So no cut last night from the Bank of Canada. Today, we've got the European Central Bank. They decide on interest rates at lunchtime today. Most people expecting no change from the European Central Bank today. But later on in the year, different story. This is Christine Lagarde, president of the European Central Bank, speaking a couple of weeks ago in Davos about the outlook for inflation and therefore interest rates.
I'm confident that short of another major shock, we have reached a peak. Okay? I know some people argue that maybe we are overshooting, maybe we're taking risks. I think the risk would be worse if we went too fast and had to come back to more tightening.
Khatija, how do you interpret all of this central bank speak?
So central bankers have been quite cautious about the speed with which they potentially will ease monetary policy. So the story is we think inflation has peaked, and that's consistent in the US, Europe, and the UK, most major economies. But we're not really sure whether we've got it beaten completely. And I think one of the issues, particularly for the US, is that the economy is still so strong. Unemployment is very low. And so the Fed doesn't want to start easing monetary policy and find that inflation resurges again later in the year. So they would rather be cautious, be very confident that inflation has been beaten and is sustainably declining before they start to ease rates. And I think that's consistent with what Christine Lagarde was saying, and also what the governor of the Bank of Canada was saying. They don't think they need to go higher, but they're also not going to rush to cut. Now, in terms of what the market is expecting, the market is much more aggressive in pricing rate cuts than the policymakers have indicated, and that most analysts expect. So, for the ECB, for example, the market's pricing 5 rate cuts before the end of the year, 25 basis points each. We're expecting 3 from June onwards. And it's a similar story for the US and the UK. So markets seem to be very confident that inflation will continue to fall quickly. There are still some upside risks. We've had shipping disruptions in the Red Sea, which are already starting to feed through to longer delivery times in the UK. We had that data last night. And so potentially that puts some upward pressure on inflation, particularly in Europe. And then, we don't know what's going to happen in terms of energy prices. That may also be a source of inflation later this year. So I think it's sensible for policymakers to wait and see.
A couple of minutes left. The Federal Reserve meets later on this month. At the start of the year, the markets were pricing in a March rate cut in America as almost a dead cert, more than 80% according to the futures markets. I'm looking at them this morning, only a 40% chance of a rate cut in America according to futures markets. We got to doff our cap to you and the team at Emirates NBD, because even on the 1st, 2nd, 3rd of January, you guys were saying no rate hike in March. I mean, we don't know yet if you've been proved right, but it seems the wind is with you.
Well, I mean, March does seem very, very early because, again, the US economy is trucking along. We get GDP estimates for the 4th quarter later today. But in the 3rd quarter, the economy grew almost 5%. Unemployment is below 4%. It doesn't really, look like a situation where we need central bank easing to support growth or reduce unemployment. So, we think March is very early. Potentially, we see something towards the end of the 2nd quarter. So we've got 25 basis points in cuts priced or expected in June. We may see that in May, perhaps, if inflation falls really quickly. But services inflation is sticky, and I think that's key. We've had a fairly rapid decline over the last 6 to 9 months, but we may not see that rapid decline continue. We may actually see inflation kind of stuck where it is for several months now.
10 seconds left. Abdul Salam says inflation is easing. Does that mean prices are falling, or they're just rising less fast?
They're rising less fast.
Thank you very much indeed. Khatija Haque, Chief Economist, Emirates NBD. Always good to see you in the studio. Appreciate you coming in this morning. This is the Business Breakfast.
By 103.8.
Join the conversation.